All right, welcome back to Talk Tickers. Today, we're diving into the Q4 2025 earnings for the trucking giant Knight-Swift. You know, the freight market has been, well, it's been in a serious downturn, so all eyes were on these guys to see if they can navigate the storm. Let's see what the numbers had to say.
And there it is. That's the market's instant reaction right after the bell. A pretty sharp drop, down over 4%. So the big question is, what exactly spooked investors here?
Well, it turns out the reason was pretty straightforward. They missed expectations, and not just by a little. We're talking across the board. Their adjusted earnings per share, the EPS, came in at 31 cents, when analysts were really looking for 36 cents. And revenue? That fell short too. Look, in a tough market like this one, you really need to see a beat. And a miss like this, it just immediately sent the stock into the penalty box.
But, the headline numbers almost never tell the whole story, right? So let's do what we do here. Let's peel back the layers and really dig into what drove these results, segment by segment.
Okay, this is actually pretty interesting. You can see this real split in performance. On one hand, their main truckload business, their bread and butter, is feeling the pressure, with revenue down over 2%. That's the soft market really taking a bite. But then, look at the LTL side. That's the less than truckload segment. It's actually growing by 7%. So it just goes to show their diversification strategy is definitely helping, but clearly it wasn't quite enough to make up for the big slump in their core business.
Now, you might have seen some scary headlines about a GAAP loss, and I really want you to pay attention here because this is super important to understand. This was not an operational cash burn. It wasn't like the business was hemorrhaging money. No, this was a strategic, non-cash accounting charge. Basically, it's an on-paper move. Management decided to fold their smaller Abilene brand into the much larger Swift network. Why? To get more efficient. So think of it as a strategic cleanup move, not some kind of operational crisis.
So, okay, the past quarter was definitely rough, no doubt about it. But for anyone investing, the real question isn't about the past, it's about the future, right? What is management actually going to do about it? What's the plan to turn the ship around?
And you know what? Management came to this call prepared. They laid out a really clear strategy, and it's all about focusing on the things they can actually control, no matter what the crazy freight market decides to do in the short term.
So here it is, the three main pillars of their self-help story. First up, a relentless, almost obsessive focus on cutting costs and using tech to get way more efficient. Second, simplifying everything by rolling up their brands, just like they did with Abilene. And third, and this one's interesting, they're positioning themselves to actually benefit from something external. Tougher government regulations, they could really squeeze their smaller, less compliant competitors right out of the market.
And look, this quote from the earnings call, this is really the whole ballgame right here. Management is basically saying, hey, even if the market goes absolutely nowhere, our own internal cost cutting is strong enough to expand our profit margins next year. In other words, they're telling investors loud and clear, we are not just sitting around waiting for a market recovery to come and save us.
And here's what that second pillar, that brand simplification, looks like in the real world. You see them folding the smaller Abilene brand into the giant Swift network. That just cuts out a ton of complexity and extra cost. They're doing the exact same thing in their LTL business, moving to one single brand so they can better target those big national customers. The whole strategy is super simple. Focus and efficiency. That's the name of the game.
Right, so let's talk about that third pillar, the external one, because it's pretty clever. Management thinks that the government is about to get a lot stricter on things like driver qualifications and safety. And who does that hurt the most? The little guys, the smaller carriers. So the thinking is, if some of that competition gets pushed out, that tightens up capacity across the entire industry. And what does that mean? A better pricing environment for the big, compliant players like Knight-Swift. It's a bit of a strategic bet for sure.
Okay, so let's take a step back. What do we have? On one side, you've got some pretty weak current results. But on the other, you've got what seems like a really credible plan for the future. So how do we weigh those two things against each other? How do we come up with a final verdict on the stock? Let's get into it.
And this right here is the fundamental tug of war happening with this stock. You've got management pointing way down the road, talking about 2026 and all these internal fixes they're making. But the market? The market has its ear pressed right up against the speaker of the here and now, and all it's hearing is that Q4 miss and the pretty soft guidance for the next quarter.
And speaking of that soft outlook, here it is. This is the guidance that's really acting like an anchor on the stock price. The midpoint for Q1 is just 30 cents. That's even lower than what they just reported for Q4, and it's a huge signal that these tough conditions aren't going away anytime soon.
It's this soft, short-term view that's making it so hard for investors to get excited about that longer-term story management is trying to tell.
So when we put all of these pieces together, our rating on Knight-Swift is market perform.
And here's the reasoning behind that. Look, the internal turnaround plan, it's solid, it's logical. We absolutely believe they can pull it off and save a bunch of money. But, and this is a big but, they are swimming against a very, very powerful tide. And that tide is the weak freight cycle. All these great internal improvements probably aren't going to be enough to make the stock a huge winner until we see the broader market actually turn a corner. It's a good story for sure, but it's shaping up to be a bit of a waiting game.
So if we're basically stuck in a holding pattern here, is there an interesting way to approach this? Let's talk about a potential trade.
Okay, for investors out there who actually believe in that long-term story, but figure the stock is probably just going to trade sideways for a while, a covered call strategy might be worth looking at. So here's the simple version of how it works. If you already own the stock, you can essentially sell someone else an option, the right to buy your shares from you later, but at a higher price. And for selling them that right, you get paid cash, a premium, right now, today. It's kind of like getting paid rent on your stock while you wait. Now, what's the catch? The trade-off is that you cap your potential upside if the stock suddenly takes off. But it's one way to generate some income while the rest of the market waits for that freight cycle to finally turn.
So there you have it. That's our complete breakdown of Knight-Swift's latest quarter. And, as always, please remember, this is not financial advice.